This is a continuation from our previous webinar. We talked about where to invest your money, and this time around we were looking at ETFs and index funds. So this is part 2, as you can see, part 2 of that ETFs and index funds. And what we talked about last time was more so introduction to what ETFs are and different types of ETFs, different types of index funds. What are index funds, and how can you invest in those assets? So today we were to talk about where do you begin when it comes to investing in ETFs and index funds. How do you invest in ETFs and index funds, and apart from that, what strategies can you employ when investing in ETFs and index funds? So from our previous webinar, we said that ETFs are a combination of stocks, or like a basket of stocks, for which have a specific end goal, which is they group these stocks based on either their sector, industry, or expectations of what the ETF needs to do. For example, dividend ETFs, bond ETFs, and other ETFs that are specific to the goal that the creators of that ETFs are trying to achieve. So that being said, we now need to know, how do you invest in ETFs and index funds? So index funds, like we said, are a list of stocks. For example, the S&P 500 index is a list of stock that tracks the top 500 companies in the New York Stock Exchange. So it's just a list. So to invest in an index fund, to invest in an index, you need to invest in an index fund, which is now issued by different companies. And one of those companies we talked about was Vanguard. We have BlackRock, which goes with the name iShares. iShares is owned by BlackRock. We have Invesco, among others. So these companies create the index funds that kind of relate to the indices that they are tracking. And then if we invest in those index funds, you end up, having an investment. Okay, so first of all, when you're trying to invest in an ETF or an index fund, like I said, what is your goal? What is your purpose? Why are you investing in these ETFs and index funds? So if your purpose is, say, earning dividends or passive income, you need to look for high dividend ETFs. If your purpose is to hedge against inflation, you need to look for ETFs that do the same, that hedge against inflation. That is, they invest in government bonds or municipal bonds and the likes. And if your purpose is to invest for, say, retirement, you need high yield, high growth ETFs that will grow steadily over time to a point where it makes sense to own those ETFs as compared to owning individual stocks. Now, with this purpose in mind, then you'll go into screening for these ETFs based on that goal. So when you're screening, you screen based on the goal that you're looking for. So if you're looking for dividends, you look for high dividend ETFs. If you're looking for growth, you look for high yield, high growth ETFs. If you're looking to invest in, say, emerging markets, if that's your purpose or your goal, you look to invest in emerging market ETFs. So whichever criteria you choose will determine the type of ETF or index funds to invest in. And then once you decide that, then you go to screening for ETFs. And just like screening for stocks, we we employed our favorite tool, which is FinViz. FinViz, you can use FinViz to filter out ETFs and look for them. Now, to decide whether it's a good ETF or not, you'll need other tools or platforms to do that. And today we're going to talk about some of these platforms where you can either screen or analyze an ETF or find information about an ETF, and then see to it that when you're investing in it, you're investing in something that is going to make you money over time. So just to go straight to the whole process, I'll just bring this window right here. If you're watching, you'll be able to see this. But if you're listening, you can find the video later on YouTube. Please, when you go to YouTube, subscribe, like. That way I know the content I'm putting out there is helpful. At least I get some sort of feedback out of it. So let's come to FinViz right here. The regular FinViz screen, and the first thing you do is under industry, you change from you select ETFs. ETFs will be right down here. If you scroll down a little bit, you'll see exchange traded fund right there. So that whatever comes in your screening will be specifically exchange traded funds. So you can see on this list, it says exchange traded fund, exchange traded funds. And as you can see, there's 2,120 of these exchange traded funds. So there's a lot of them. And then now you need to figure out which criteria are you using to filter out this ETF. So if you're looking for, say, dividend investing, you'll come here and select dividend under dividend yield and select which percentage of dividends you want. So over here it says high dividend yield is 5 and above, and very high is over 10%, and positive is over 0. So you want something that is high. So you select the high right here, and that will populate a new list with only ETFs that offer high dividends. Okay. And then the other criteria you use is a price. So according to your capital and how much you want to invest, you need to choose a price limit, because yes, you can find an ETF that is $100, $300, but can you afford to buy, several of them at once? If the answer is no, then you need to figure out how much can you afford and which value should you choose. So for the most part, a lot of people can afford anything between $10 and $50. So you select that. That will reduce the list to 121 of them. And then now these outcomes are based on dividend and price. So those are two criteria. Price is determined by how much you want to invest, and the dividend is determined by your goal, which is dividend investing. So now you have all these are dividend related ETFs within the price limit that you're looking for. Now we want ETFs that are on the that you can buy, the ones that are on that point of buying. You don't want to buy an ETF that is too high when it comes to price right now, because you know what happens. There's cycles. They usually go up and down, just like stocks. They go up and down, up and down. So you want an ETF that is down, so that when you buy it, at least you're buying it at a lower price, and then it will grow. And then if it drops again a little bit, you buy more, and then it goes up, and you keep doing that. So one of the ways of doing this is choosing something like a 52-week high. It should be within, below 50% of the 52-week high. So over here, you can see if you go to the 52-week high or low, there is a 50% or more below the high. And if you select that, it's going to reduce the list to only 2. Now you realize these are 2 ETFs that are below 50% of their previous high within the year, within 52 weeks. And this is a good list. Basically, it's just two of them. But even the first one is good enough for you to actually consider, because now you have an ETF that is really down over 50%, and it's within your price range, and it's a high dividend ETF. So now that you have this, you consider also the volume. Over here to your right, there's a volume, and the one with the highest volume is usually more preferred, because that gives you the sign of liquidity and volatility. So it means they move a little bit faster, and over time, if you want to sell them, you can sell them a little bit quicker than the one with lower volume, like the second one right here. So this with 200,000 volume is better off than the one with 3,000 volume. So let's look at the first one. Now you want to know what this ETF is all about. The first thing you want to know is the chart. How does the chart look like? That way you are assured of, okay, is it actually where it needs to be for me to buy? Like, you can see the big picture, this long term, short term, how has it been doing, and all that nice stuff. So our favorite tool that we used before is TradingView. And when you go to TradingView, you can search for stocks, ETFs, and all that other stuff. So the ETF we found is FINX. So you come here to FinViz and you type there FINX. This is a global fintech ETF. Okay, and now let me shift this to daily, because weekly seems to be a little bit tight. Now you can see this ETF is down close to the 2020 drop. Okay, it's been here before, back in 2018, December of 2018, it was around there. 2020, March of 2020, it was around the same price, and then early May this year, it was around the same price. Now, if you look at the recoveries from the same point in 2018 to the highest point it went to before it dropped, it did 67%. And then the second time it was down and it went high, it went to a high of that 52, and it did 167%. Now, if it's down again, chances are it's going to either do close to that 167% or even more. And like I said, you want to buy when it's low and then sell it when it's high. So this is a good point to buy, because the recovery is from here all the way up there. And let's look at what that will look like. So if you're buying right now, you buy it here, and then it goes up to there. That's 120% just to get to its previous high. And then if it exceeds that previous high, you're looking for more than that. Okay. So This is your chart. You're looking at it. You can even go to the 15-minute, which is a closer time frame. But like I said, you are investing in this for long term, not short term. So even on a 15-minute, it looks good. It looks like you are a point where you can buy. But because we are doing long term, we will look at mostly daily and weekly. That way you'll see the trajectory of the growth of the ETF over time. So as you can see from, I think, inception back here, this ETF from around here all the way, 200 and something percent cumulative. I know if you consider the dips, it's probably more than 267%, but that's how you do it. You look at the trajectory. If the ETF just started from up here and all it's doing is going down, then that could be a problem. So this ETF looks like a good one. Now you can check stuff like dividends right here. They had a dividend and they paid $2 per share in dividends, and that was January of 2022. I think they didn't pay dividends before then. Maybe there's other reasons for that, but so that's one thing you need to look out for when you're looking at the chart. You need to look at how often do they pay the dividends, among other things. Now, once you have that in mind, now you know it's a good ETF. It's going up. It has all these trajectories laid out. You go to other platforms to look at what is their holdings, what is what's in their prospectus. They call it prospectus, which is the document that shows what is their holdings, what is their purpose, what are they planning to do in the future, all those things. So a place to go for that is called Morningstar. This Morningstar is a website too. You go to morningstar.com. Then this will show you a little bit of what they're all about, and all that nice stuff. What is this? Okay, let's do that. So under Morningstar, this is how Morningstar looks like, and you can see it has a little bit of things here. There's funds, ETFs, stocks, bonds, different markets. You can do portfolio analysis here, among other things. So when you select ETFs, it will give you a page where you can analyze ETFs and look into them. What seems to be the issue? Okay, so this is a page where they talk about ETFs and what is going on with ETFs, the ETF markets. You got articles and news and everything to do with ETFs. So our ETF was FINX, I think. So FINX. You put that on the search bar right there, and it says Global X Fintech ETF. You select that because that's the one we were looking at. And right here, there's a little bit of loading going on, but you can see there's a quote, fund analysis, there's performance, sustainability, risk, price, portfolio, among other things, the parent company. Now, just from here, you can see the day range is between 23 and 23.28 and 23.87. The yearly range is 21 to 53. So within a 52-week time frame, the lowest it's been is 21, and the highest it's been is 53. But within today, it's been at 23.28 and 23.87. So you are close to the yearly low as compared to the yearly high. So if you're coming in to buy this ETF, you need to buy as close as to the bottom, because that's essentially what we call the bottom. And then from there on, it keeps going up. This is a 12-month yield right here. It says 12-month yield. It's 8.7%. So if you just took your portfolio, your capital, and invested it into this ETF, in a 12-month period, this ETF will earn you 8%. As simple as that. You just take your money, buy this ETF, and give it 1 year, it will compound by 8%. So among the reasons as to why you invest in ETFs like this is because you can just buy the ETF and settle. You don't need to be checking every day, buying, selling every day, doing day trading, and doing all those things. If you find one that has a good yearly yield, which is a 12-month period yield of around 8 to 15%, that's a good one to just buy and hold and keep doing that for as long as you can. So with this one, it gives us 8% if you just had to do that. But then if you start doing dollar cost averaging, buying when it's low, and monthly investing, which is you start with a lump sum and then you keep buying every month, maybe 5K, 10K every month, you realize that over time, this yield will grow even higher. Then on top of that, if you add the dividends and all those other things, the outcomes will be very good. So we go to fund analysis, where you'll find other people who've analyzed the ETF and what they say about it. So that's under the analysis part. And if you look at it, you need a premium subscription to see what other financial advisors have said about this this ETF. So that's out of the question right now, because we only have a regular subscription. Then you go to performance, then you can see how has it performed over the last, I don't know how long, or however long you would wish to check. So here, there's a few things we see, and one of those is different colored lines. So we have a blue line, we have a yellow line, and we have a red line. And what these are, I'll explain them. So let's start with the red line. The red line is the index. Like I said, the index is just a list of stocks. And then the ETF or the index fund tracks that list or that index. Now, if you're looking at global fintech index, we're looking at this red line. That shows you all the indices out there that tracks the global index, the global fintech companies. So the index that tracks the global fintech companies is represented by red. And now you can see all these other lines, they kind of mimic the red line. It's like a copy of the red line, but a little bit different from the red line. And then the yellow is a category. Category refers to the category of ETFs, like the one you're looking at. So other ETFs that track the same index, how are they performing? And you can see the yellow is slightly below the red, and slightly above the blue right here. But in other places, the blue was above, and then in other places, the yellow was above. So the ETFs in the same category, or tracking the same index, have performed this way. This is how they've performed. Now, the blue line is our global fintech ETF, FINX. As you can see, blue right here is our ETF. And you can see at some point it was doing better than the index and better than other ETFs in the same category. And then come 2021 towards the end, and then 2022, it's now performing below the index and the other ETFs. So if you're trying to gauge the performance, you realize that this is a high performing ETF when things are good, but when things go wrong, then it drops a little bit more. So that's the performance. And then now you can scroll down and see other performance metrics like total return percentage right here. One day it's doing negative 3.9, 1 week is negative 3, 1 month is negative 15%, 3 months is negative 23%, year to date is negative 41%, 1 year period is negative 44%, and then 3 years is negative 4, and then 5 years is 6%. So you can see here that this ETF hasn't been performing well recently. As you can see on the graph, also on the chart right here, it's been dropping really very fast. And then on top of that, even 3 years down the line, it's not been doing well, which is also indicated in the chart right there. But 5 years ago, that time frame from now to 5 years ago, it's relatively okay. This is low performance, but you can use this to probably hedge against inflation or something. Maybe combine this with other ETFs to maximize your performance of your portfolio. And now, if you look at the category of the similar ETFs, some of them have done 12% in the last 3 years, and they've done 13% in the last 5 years, 15% in the last 10 years. And the index or index funds in this with the same index are doing really well, 3-year period at 21%, and then the other ones are doing they're doing 19% in 5-year period and 18% in 10-year period. So if you understand money markets in Kenya, they tell you we'll give you 10%, we'll give you 9.5, or if you're lucky 12. But you can see if you ended up investing in an index, you invest in an index, a 3-year period can give you 21%, which is probably 10% more than what a money market fund can give you. So this is just a comparison of the ETF and the index. So index funds, some of them perform better than the ETFs. As you can see here, the index is doing way better than the ETF, which is in blue, and the index is in red. So the index is doing way better as compared to the ETF. And therefore, when you are creating a portfolio, you might want to invest in the index and combine it with the ETF. For example, other ETFs other than this one, for example, will do you better in combination with an index or a different type of ETF, and that will give you a better outcomes. You'll be doing probably over 20 to sometimes even 40% a year returns on your investment, which is way better, way better than money market funds. And I think even circles don't do this good. So if you're considering a place to put your money, think about index funds and ETFs. Now, you can go through all that and see how it goes. Right here, under performance, we look at distributions. And then this is just how much they're paying in terms of dividends over time. So December, they gave out $2. 2018, they gave out 0.0021. So this is, yes, it's a high dividend income, high dividend ETF, but compared to other ETFs, it's not really doing that well. So as you can see, just finding it on FinViz is not good enough to tell you that you should buy it. But now when you go to a platform like Morningstar, you can figure out that, oh, look, it doesn't give out as much dividends as I thought. Maybe it's not as as high as I expected. The performance, we have looked at the performance, is not as good as I expected. Therefore, maybe it's not a good idea for me to invest in this one, but maybe the next one will be a little bit better. So once you know the performance, both the returns and the distributions being the dividends, then you can now think of what are the risks involved in investing in this ETF. You come here to risk. And this will show you a few metrics that are used to determine the risk of that investment. Okay. And right off the bat, you can see that risk versus category, that is the risk of this ETF compared to other ETFs in the same category, this is an above average risk, right? And then when you look at return versus category, that is the returns of this ETF versus other ETFs in the same category, you realize that it's a low return ETF. So that will tell you if you should invest in this thing or not, because with these metrics, then you realize this is a high risk ETF with low return. Okay. Now it will tell you it's not a good idea to invest in this ETF because it's a very high risk, but then it doesn't compensate with returns. If it was above average risk but very high return, it would have been a little bit better. But the way it is right now, it says it's a high risk or slightly above average risk, but with low returns, which is not good for investing. Now that's a 3-year time frame. Let's look at 5 years. And 5 years again is almost the same above average risk and below average return. Then at 10 years, there is no insufficient data for that. So at 3 years, you can also use this, I don't know if it's a histogram or something, but you can see right at this mark right here is where the index is. And then this is the category of similar ETFs that tracks the same index. So the ETFs are performing below the index. And then our ETF that we're looking at, the Fintech Etf, is performing way, way below that ETF. Now, on top of just looking at it from the get-go, which is you can just open Morningstar and look at this page like this and say, this is a high risk, low reward ETF. I probably don't want to touch it. But then you might want to go deeper to analyze it and say, okay, what other measures of risk and reward should I be looking at that will make a difference? And those are alpha, beta, and mostly standard deviation. All these other ones are relative. It depends with how you analyze them. But let's start with the alpha. Alpha is the metric that is used to determine the performance of that ETF. So a positive alpha is better off than a negative alpha. And mostly if it's above 1, it means it's doing better than the index. But if it's below 1, then it means it's doing worse than the index. So right here you can see our ETF has an alpha of -10, but our index has an alpha of +10, meaning the index is performing way better than this ETF. And if you're trying to invest in this ETF, you might want to choose a different ETF that performs close to the index than the one we're looking at. Now, beta is the measure of volatility, how volatile the ETF is, and anything above 2 is very volatile. Anything below 2 is averagely volatile, and anything close to 1, closest to 1, is almost not volatile. So anything below 1 then becomes too slow. You don't want stuff that is below 1 on the beta because it's too slow. It doesn't move that much. If it's going up, it goes up very slowly. So you want something that is above 1, like this one, 1.4, 1.8, 1.1. That way, it's volatile, yes, but it's not too volatile that you buy today and it drops 20%, or you buy today and it drops 50%. So if you're looking at volatility, it shouldn't be higher than 2.5. And that's when you're screening also, let's get rid of this and try and use that for screening. You come here, there's beta right here. And this you can choose and say, I want a beta of below 2. I don't know if we have below 2, but under 2. This one right there. So that shows you an ETF that is not too volatile. So it's something you can choose, or you can say something that is let's say over 2 will be more volatile than the rest. Okay, that doesn't give us anything. Let's say over 1.5 and see what comes up. So I suppose most of them are between 1 and 1.5. I don't know. That's weird. Oh, no. What did I do? It should be over, not under. So when you're selecting, just make sure you're looking at what you're choosing, because if you choose a different criteria, it will give you a weird outcome. So confirm your choices before you pick an ETF to analyze. So apparently this outcome that we have doesn't really give us much to go with when you're looking at using beta as a filter. But if we were to use the one under 2, it will give us that one ETF, and this is something we can look at. But then let's go back to our analysis where we were looking at beta. So when you're screening, you can use this as your criteria, because that will determine the volatility, or you can use the alpha, which is the performance. And then standard deviation is a measure of performance too, which is anything that is positive is better than anything that's negative. So the higher the standard deviation, the better the performance. And we can see here, this had a 30, and the index had 22, the category had 25. Now, if you compare that to the performance chart we were looking at, it showed that whenever things are good, this ETF performed really well. But whenever things were bad, it underperformed. So to determine how good the ETF can perform, you look at the standard deviation, and you can see it can really do good when things are good. But when things have gone wrong, then you see it's not performing so well. So combining standard deviation, alpha, and beta will give you a better way of analyzing an ETF, and that way you can figure out if it's a good investment or not. Now, the other part we'll want to look at is the portfolio. And with the portfolio, it will give you the list of companies that this ETF is investing in. That list is a portion of the list which is in the index, or probably more than that list that is in the index. So let's come and look here, and you can see how the distributions are, or the allocations. U.S. equities constitute 66%. Non-U.S. equities constitute 33%, so making that close to 100%. They don't have anything fixed income. They don't have cash, which is 0.04. That's almost nothing. Then we come here, we see other metrics. Price to earnings ratio is right there. Category and index is outdoing this ETF, because this is doing 9 and this is doing 16, and the other one, the index, is doing 4. So as far as earning goes, it's not doing so well compared to the other ETFs. Price to book ratio is not also doing well compared to the other ones. Price to sales is not doing well compared to the other ones, but the difference is a little bit minute. But because we were looking for dividend investing, we'll more so be inclined to look at how does it do dividend-wise compared to the index and the category of ETFs in the same following the same index. And we can see dividend-wise is doing almost half of what the category is doing and the index is doing. So yes, it's high dividend, but it's not so high because there's more, or there's other ETFs that are doing better than that one. And then long-term earnings over time, like I said, the standard deviation comes in here, and you can see it's really doing good compared to the other ones. But then volatility and the other measures bring it down. Sales growth also good, and then other things follow after that. Now we want to look at what companies are they investing in, and because it's a fintech company, we can see here they're mostly invested in financial services at 16% and technology at 81%. So that brings that fintech concept into this investment. So financial investment technological companies. So what companies are in their holdings? That's the next thing you need to know. And you can see here we have Pfizer. We have Intuit. Intuit is the ones that own QuickBooks. If you've done QuickBooks before, you know that. Fidelity. Fidelity. I don't know if they're related to Fidelity Bank and Fidelity Financial Services. Among other ones here, most of them I'm not familiar with them, but you'll soon, over time you'll discover some of them are more familiar. They have PayPal in their holdings. They have Coinbase. Coinbase is a cryptocurrency exchange company. They have Sophie. A while back we were discussing Sophie. You could buy Sophie as a stock by itself, which is right now it really dropped. Sophie. So for a fintech company, the Sophie is in the financial industry. They give out loans and credit cards and other things. And as you can see, the reason as to why that ETF is not doing good is companies like Sophie have dropped really, really a lot. So from November of 2021 to around May this year, it has dropped 80%. Yeah, that's why this ETF is not doing so good. If we look at PayPal, we can see PayPal has also dropped very much recently. And what is the drop with PayPal? There we go, 76%. Okay. So while you're looking at which companies have they invested in, you'll realize that the performance of those companies, like here PayPal, will be more of a reflection of what the ETF is doing right now. So if majority of these companies have dropped, then it means that ETF has dropped. Now, this could be considered an opportunity or something to think about, because if PayPal is down 70%, Sophie is down 80%, who knows what Coinbase is down at? Who knows this Nexi? Who knows Coca Pay? You know, all this. How far have they dropped? Now, if they've all dropped by over 50%, what does that tell you as in terms of opportunity? It means at some point when these companies start recovering, then if you own this ETF, you will be owning multiple companies that will be recovering, all of them almost at the same time. And that performance drop on the ETF that we saw under this tab right here, under performance, will change the trajectory way back up more than even the index itself, because we now know that majority of the companies this ETF is investing in have gone down significantly. So that's one way of determining if it's a good investment to make, buying this ETF or not. And the last what do you call it? The last list. I know there's more than this, but the Morningstar non-premium subscription only gives you 25, a list of 25. So we know Affirm, we've looked at Affirm before, and I'm sure if you look at it, it's probably down also. Affirm Holdings, they give out loans and other things, and as you can see, Affirm is also down from up here to down there, 90% from its previous high. They have Upstart, similar thing. They give out loans. This is like in Kenya with mobile loan companies. So US also have these companies that give out small loans to people through their phones and stuff. So these are one of those fintech companies that do the same thing. So Upstart Holdings, I'm sure is also down by almost similar percentage. And as you can see, like I said, it's down, and this is down 93%. So from what we've gathered, we've now discovered that this ETF has invested in a lot of companies that have gone down significantly. Could be an opportunity for you to now buy, as we expect maybe with the inflation and everything, if that goes away, some of these companies will go up. And then if you're invested in it, this is a good point, because you're investing in it when it's almost at its lowest point. And then when it recovers, then you'll be good. So we looked at that Finex right here. And you can see all that drop of those companies constitutes this drop. And then now if it recovers from here to probably back to where it was, we're looking at 143% and above, something like that. So in a nutshell, that's how you go from finding an ETF from FinViz with a criteria or a goal that you are trying to invest for, and then analyzing it with a trading view. You can see the chart, how it looks like, and then go to Morningstar to figure out the risks and return numbers. You can also look at the companies they've invested in, the holdings, geographically, region-wise, which countries, all that. You can look at all those metrics and numbers and whatever ideas. Other than that, you can also look at the parent company. What company is responsible for this Finex Global Fintech ETF? And with Morningstar, you can see that as it loads right here. The firm name is called Global X Management. It does US ETFs. Total net assets they have is $40 billion. Investment flows at $15 billion. Asset growth return at 47.9%. So it's not a bad company essentially, but for that one ETF, they're not doing so good so far. Other than that, they have other investments like the Global X, other ETFs, Global X US Infrastructure Development ETF. They have the Nasdaq 100 Covered Call ETF. So if you're doing options, this is one of those ETFs that invest in options in Nasdaq companies, 100 of them. They have lithium battery ETF. They have energy, MLP and energy infrastructure ETF, and they have S&P 500 Catholic values ETF. So whatever this is, you might want to look into them later on. And now they have, these are their highest rated ETFs, and these are their lowest rated ETFs. So one of them, which is lowest rated, you can see right here, is the Global X Fintech ETF. So this gives you an idea of what other people are thinking about this ETF, and therefore will determine whether you are more inclined to invest in it or not. So instead of, say, investing in this Global Fintech ETF, you might want to invest in the Infrastructure Development ETF of the same company, or the Covered Call ETF, which is it has 4 stars, so it should be good. So yeah, so that's how you move from screening to analyzing. Make sure your RSI is down there, your indicators, whichever ones you use, you're good with that. And then once you get from there, you go to Morningstar, and you can see up to which other ETFs the company that holds that ETF has, on top of the performance, the risk, and the holdings. Now, that's just one way of doing it. We had one goal, we followed that goal, we found an ETF, we analyzed it, and now we've discovered chances are we might not want to invest in it. Or if you are a more risk taker, you can invest in it knowing that when things start doing good, this ETF will do better. But then after you're done all this, you reset and then go back and start afresh. Like now we changed a few categories here, and we have a different ETF, and you can do the same thing. Start again with Trading View. Find that ETF. It's called Wisdom Tree Emerging Markets ETF. Okay, I think that's the name of this thing. Wisdom Tree Emerging Markets Local Debt ETF. Then you can see what it's doing, and now you can see this one has more dividends. So they're giving out 0.21 dividend almost every month, I think. So if you're looking for monthly income with an ETF, this is a good one because it gives out every month dividends. Now this is 0.21 of a dollar. So if it gives you 0.21 of a dollar, if you want to make, say, $200 every month out of this, so $200 divided by 0.12, you'll need to buy 1,666 shares of this ETF. Then that times the price, which is now at 26.8, you'll need to invest around $44,000 to earn around $200 every month. So as you can see, this is something you can build on over time, which is if you have money that you earn regularly, you keep depositing and buying this ETF over time. And by the time you realize what you've done, you realize you have maybe 20K, 30K into an ETF like this. That is 10K, 20K USD, which is 1 million to 2 million, for example. It's achievable, it's doable, but yeah, let's talk about that. You get to that level, you have 10K in one ETF, you have 10K in another ETF, you have 10K in another ETF. If you only have 5 of them and they're doing monthly dividends like this one, chances are you'll be earning around 100K a month. And at that point, your income issues would be solved, and you might not need, you might not need to go to work. You'll be earning your income passively. So that's how we go about investing in ETFs. Now, if you change a criteria, you'll get a different outcome. If you change a price, you'll get a different outcome right here, description, all these things. Change something and you'll get a different outcome. Just to try and wind up, there's this website called etfdb.com. Under etfdb.com, if you go to tools, you'll see they have Etf Screener. And then this Etf Screener is more specific to ETFs. And with this, you can choose either bond ETFs, commodity ETFs, currency ETFs, equity ETFs, multi-asset ETFs, preferred stock ETFs, real estate ETFs. You can pick and choose. And then with this one also, it gives you a variety where you can actually see the issuer, for example. And this is a list of companies that give out ETFs. Like I said, one of the top ETF issuers is Vanguard. So you can specifically filter out all ETFs by Vanguard like that, and it shows you here they have the total stock market ETF VTI, they have the S&P 500 ETF VOO, they have the FTSE Development Markets ETF. This is, I think, mostly UK VAE, Value ETF. So this is they have the total bond ETF BND by something happened. Okay, by Vanguard. So if you are a fan of Vanguard, this would be a way to filter out all those other companies and just leave out Vanguard. But for me, I like Vanguard. I like Van Eck. Van Eck is a good company for ETFs. I like what is this other one? iShares, which is it's under BlackRock. So we go back up to B. BlackRock gives you more of iShares. Invesco is a good one. This one right here, Invesco. And then what is the other one? Charles Schwab. I don't know if it's under S or under C. Schwab. I think it's under C. Charles Schwab. Okay, there. Now we can see this gives us a list of those companies, specifically those companies that we like. And then now you can see stuff like QQ. Somebody was asking me about QQQ, a very good ETF. Now, I was saying, just to wind up, how do you now invest in ETFs for long term? Okay, long term, you want to be hands free. You just put money. You're buying ETFs maybe every month, all that. What you can do is create either a 3-fund or 4-fund ETF portfolio, which means you buy something like the Vanguard S&P 500 VOO, the Vanguard Total Market ETF, and then you buy something like the Vanguard Bond ETF. You can only buy those 3, and every time you deposit your money, you buy one. Then next time you buy the next one. Next time you buy the third one, and then you repeat. And you do that every 3 months. You're buying one of them. Every 3 months you're buying one of them. And before you know it, by the time you hit, let's say you're doing this for retirement. By the time you hit 10 years since you started, you realize you'll have a very nice portfolio that will earn you good returns by the time you hit that 10-year, 20-year mark retirement age or period that you had selected for yourself. So this is that tool. It's called ETF database or etfdb.com. You can go to tools and select screener. And then with this screener, you can screen for specific ETFs from specific companies with specific things like dividends. You can select how much dividends should they be giving out, how much expense ratio should it be, lower expense ratio, high dividend ETF. And just like that, you see you're only left with 3 of them. So that's that. Right now, I know we've been on for over 1 hour. I would open the floor to questions and anything you have in terms of investing. It doesn't have to be ETFs, but as long as you have something to ask, this is the time to do that.
Okay, thank you, Alan. That's been a very good discussion.
Yes.
Yeah, I have a question with ETFs and money market fund.
Mm-hmm.
You talked about this. Maybe in a year we get an interest of about 8% in ETFs.
Yes.
So they are the normal for daily traders. Maybe you can get maybe either in a month or in less than a month you can get maybe more than 20%.
Yeah.
The advantage of trading ETFs other than the normal trading, because I was seeing both of them they are risk, and the other one maybe high interest, and the other one has some low interest. Then the other one on ETFs, there is a lot of volatility. With
On
the
ETFs.
same interest, yeah. Another question on ETFs. Yeah, there is this point of volatility.
Yes.
So maybe you a certain amount of money, maybe you bought some shares.
Yes.
What will happen due to this volatility? Maybe the company is making some losses. What will happen? Maybe to the amount of shares that you bought, will you get some interest, or there will be no interest at the end of the year?
Okay. So when it comes to volatility, the stock market always goes up and down. That's known. There's always those swings. ETFs are less volatile compared to individual stocks. Like we had seen here, if we look at that Finex ETF, this ETF has dropped. It was what? From the high to the lowest, 57%. But if you had invested in PayPal, which is a stock in that ETF, yeah, PayPal has dropped from the high, has dropped over 76%. Upstart had done what? Over 90%. So when it comes to volatility, ETFs are less risky than individual stocks. That's one thing that you might need to look into. So ETFs offer that hedging against risk, in that sense that you're not only investing in one stock that can drop 90%, you're investing in several stocks, and not all of them will drop by 90%. Some will drop by 90, some will drop by 50, some will drop by 10, some will make profit, maybe 10, 20, 30%. So ETFs help you with managing risk in that sense. The other thing is, because of diversity, you get better outcomes than investing in individual stocks. Now, you said the 8% performance. That performance was specifically for Finex, this Finex ETF. Finex ETF did 8%. Now, there's other ETFs. If you look, you'll find something like this. This is SOX, semiconductor, iShares. I told you about iShares. iShares semiconductor ETF. Let's go here to performance, and you'll see this performed way better than Finex. So the 8% I was talking about compared to money market funds was specifically for Finex. Finex was doing that. But if you look at iShares, compared to the index. The blue is the iShares, and the index is the red one. Now, compared to the index, iShares is doing very well. Okay, look at this one. When we go to returns, where is that return part? Look at this. 3-year return is doing 31%. 5-year is doing 23%. Yeah, 10 years is doing 24%. 15 years is still doing 14%. For 15 years, 15-year performance period, 14%. So money market funds, yes, they're okay, but consistency. How consistent can they give you 14% in a period of 15 years? How can they consistently give you 23% in a period of 5 years? That's the difference, and that's why I would encourage people to invest in ETFs, because not all ETFs are the same. That's one thing. When you're screening, when you're searching, when you're trying to do long-term investing, try and look at its track record performance. Now, this ETF year to date is down 28%. But I can tell you this: if this ETF recovers, you'll be doing way better. This is performance of this ETF. If you had invested $10,000, that is 1 million, back in 2012. By the time you got to today, first of all, you'll have around $89,000, which is 8.9 million. So you invest 1 million here, you get 8.9 million by today. That's 10 years later. If you had taken out your money before the crash of end of 2021, you'd have $125,000, which is 12 million, by just investing 1 million back in 2012. So some of these ETFs are good for long term, in this sense that, yes, right now you might not see the difference, but if you keep it in there for a long period of time, you can earn that much. And then now, compared to money market, consistency is key. How consistent can these returns, can this ETF give you returns compared to money market? So that's one other thing that you have to consider.
Okay, thank you.
Yes.